In this video, we're going to look at some of the highest yields you can get in the crypto industry. We're going to look at Pionex dual investments and some of the APYs here, 1,300%, 500%, 355%. How exactly are these APYs paid? Should you even get involved with this? What are the risks? How should we use it? And who are these products for? I'm going to go through all of that in this video. Timestamps for each section are in the description below. If you want to sign up for Pionex, you don't have an account yet, you want to get into these products, I will leave that link in the description for you as well. They do sometimes offer deposit bonuses and everything, so click that link to find out what the offer is at the time you're watching this. Okay, firstly, we have to understand what a dual investment is and if it is suitable for you. There's lots of things to think about here, so I'm going to go through that all in this video. But you can see if you want to invest US dollar tether, you're getting crazy APYs. Well, how is that paid? Where's that APY coming from? What risks are we taking? And then obviously you can look at investing Bitcoin or ETH, and you can see these similar APYs are very, very high. So we want to really think about where these APYs are coming from, and if we should actually get involved with this. So here's what dual investment is, and then I'm going to explain the underlying products. So with dual investment, you can invest either stable coins or the coins themselves, and actually it's different for both. So the outcome and the risks of doing this from stable coins to the actual risk assets and the coins like Bitcoin is different. So I'll explain the differences there. You can see you can earn very high APYs. Where is that APY coming from, and is it very risky? You can actually choose your risk reward ratio. And as you can see here, there are different APYs, right? So the one today is 2,000%, right? Obviously crazy. But as you get down, you can see there is slightly lower risk and then lower returns. So we can make those decisions. You can use these products in the Pionex app. I'm just going to show you the platform right here, and I've actually taken some screenshots of my application here just to show you, some of what you would be looking at when you get into the product. So what you can do is you can invest US dollar tether, as you can see here. So this is invest USDT, and then you can see obviously the current price, and then you have a return here, either in Bitcoin or US dollar tether, and then down here you can see the APR. So we have to go through what these are. Firstly, you will actually receive premiums from the other party or the market, and that is your yield. So when it works out this yield of 354% down here, what you're actually doing is receiving a fee and a payment from the market to enter into this product. So you can see the APY is 354%. What they actually do is take a daily rate for the fee that you're getting and obviously put that as an annualized figure. So this is a short-term investment. You can't invest in this over a year-long period. You can only invest in it maybe for a few days or weeks, but obviously the amount you're earning as a percentage annualizes at 354% in this instance. If the price of Bitcoin, this is investing in Bitcoin, but you're using US dollar tether. If the price of Bitcoin is above 31K in this example, you keep your dollars and you get the fee. So that's how you make your money. If the price of Bitcoin in this example is below 31,000, you actually buy Bitcoin at 31,000. What we are doing here is an options strategy, and it's known as writing puts. And I'm going to explain this simply throughout this video. The other way you can do things is actually investing and hedging the coins that you already have, for example, with Bitcoin. So you can do it the other way. If you have Bitcoin, you can invest BTC. You can see here the current price. Then you have the potential profit here and the potential profit here. The APR, or the fee that you're going to be getting as an annualized rate in this instance, is 106%. So you actually invest your Bitcoin and then you receive those premiums from the options buyer. You are the options seller, the APY 106%. So if the price of BTC is above 32K in this example, you actually sell Bitcoin at 32K. If the price is below 32K when the settlement occurs, then what you do is you basically get that Bitcoin back, right? So you have your Bitcoin, you get your Bitcoin back and the APY. The downside of this is if the price is above 32, you actually sell your Bitcoin at 32. And so obviously you're not making as much money as if you would have just held it. So they are the risks. And I will go through all of that in the video. What we're doing in this instance when we're investing BTC is writing calls. So when we look at the APY that we can earn from the dual investment product, as you can see right on the platform here, Invest BTC, 2,400%. What we're doing is getting a fee from the other side who's paying us for the option to do something. And that fee is called a premium, which you can see here. Because we are writing options, we're giving people the option to do something in the future, either sell us BTC or buy BTC from us. I'm going to use BTC in this example, but there are many others. So when you write options, you receive a premium. It's a fee paid to you by the buyer of your option. Okay, so we're selling options to do something. The premium or the fee is the yield that we get, and then they annualize that out. Here is the flow. You can see we are the options writer in this case. So we are giving people an option to do something. We give them the right to do something, and they pay us a fee and a premium. So this is how the APY, as you can see on the system, is given to us. They pay us a fee, and that fee obviously changes dependent on the price that we agree that option to be at and the length of the contract. Some key terms that you'll need to know about before we get into these products are these. So the settlement date, that is when the option expires. We write an option, they buy the option from us. So you can see the duration here, that would be the settlement date either today or in 1 day's time. You have a target price, that is the price of the option, right? So the target price, as we can see here, is 27,000. You can see 28,000, 29, 28, 29, right? So there are different target prices and different durations. The settlement price is what the actual price in the market is at the time when the option expires, which is, you can see the duration, the target price. And then if we go to details right here, you can see this coming up. It says the current price, that's the settlement price. So the settlement price will be whatever that is, when the actual contract expires right there. APY, as I said, is obviously the fee that we're getting as an annualized rate. You can see the ROI, actually, it gives you how much you will make, which is 0.43%. But obviously that delivery date is in a day's time, or actually today, right? So you're making 0.43% in a day, which is obviously very, high as an annualized rate. Deposit currency is the one that you actually invest in, either dollars, USDT, or Bitcoin. Alternate currency is the currency that you actually get. So when you enter into the product, like it says here, if you want to go and invest Bitcoin, as long as the price is underneath this target price here, then 27, you actually still get your Bitcoin. The alternate currency is USDT, which you may get as well. And then obviously call option and put option, which is what I'm going to explain right now. And what we're doing here is writing an option. That means we're selling the option to do something to someone else. So we're the options writer and the market is the options buyer. So let me explain exactly how investing Bitcoin would work and if it's suitable for you. So we can come down to the Invest BTC option right here, and it shows us a huge APR here, and the duration is today. So do I want to get in this today? Now what you can see is that as the target price is 28,000, so we can click here, the price in the market is now 27,000, right? So what we're saying to people is, you can actually buy Bitcoin from me at 28,000 in the future when the contract expires. Now the current price is 27,000, so why would anyone want to do that? Well, people hedge their portfolios all the time, and they buy options to hedge their portfolio and to give themselves certainty. So this is the options market. It's a huge market. We are giving someone the option to buy Bitcoin from us at 28,000. Now they're gonna have to pay us a fee to do that, which is the premium, and the current price is 27,000. Here is how writing a call option works. From their point of view, from the market point of view, what they're doing is they're paying a fee, known as the premium, to get the option to do something in the future. If they have an option to buy something at 100, all right, then obviously the price has to go up for them to 100 plus the premium that they pay, which might be $2. They only make money when the price goes up above the option strike price and pays back their premium. When it does, they then become in the money because they have the option to buy it at 102, and the price in the market may be 110. So what they can do is buy from you at 102 and sell at 110 instantly, and they have that profit. That's from their point of view. What we're doing is giving them that option. So what we're doing is writing the call or giving someone the option to buy from us. And as you can see here, our total profit is the premium that they pay us. Now, if they have the right to buy Bitcoin at 28K and it's below 28K, they won't exercise that option because they can get it in the market cheaper. We pocket that premium and we're all good. We keep our BTC, as you can see here. Anything under 28K, we keep our BTC, but we get their premium and we pocket the difference. So that's really great. The downside, obviously, is if the price moves above that level, you can see our profit diminishes up until they always pay us the premium. Our profit diminishes until the price moves further out from the premium. So obviously our premium is here, and as the price moves up, obviously the amount of profit that we're in goes down until here, and then we start making not a loss. We don't lose money, but compared to, what we could get in the market, we have to sell our Bitcoin to them at 28. And if the price is up here at 29, obviously that's not great because we could have sold our Bitcoin at 29. What it does give us though is certainty. So, if the price does go up and you do sell it at 28, well, that's that. And yeah, we could have sold it for a little bit higher in the market, but we still got the premium and we had the certainty of selling. So there's pros and cons to this, but that's what you're doing right here. You're giving someone the option to buy your Bitcoin at a certain price and you're collecting their fees. A very quick recap of that though, because I know it is complex. You sell a call option to someone else. The buyer on the other side has the option to buy your Bitcoin at the strike price. In this instance, it's 28K, as you can see here. Now, obviously, at the money strikes are more expensive. What that means is what you can see right here is that we're getting a much higher APY right here. Why is that? Well, because the price is closer. Can you see this one down here is at 29 strike? That means essentially that they would have the right to buy a Bitcoin from us at 29, and the price is currently 27. So this is more likely to happen. 28 is more likely to happen than 29 because 29 is just further away from the current price. And so the fee that they pay, the option premium that they pay, is lower because there's less chance of it happening. So what you can see is that you can take more risk because if the strike is very close to the current price, they have to pay a higher fee to compensate for the likelihood of it happening. When you get something like a 30 strike, which is $3,000 away right now, much further away than all of these, you can see the APY is lower because they're paying a lower premium. So that's how the strike and the premium works right here. Out of the money, further away, the fee is cheaper for them and the APY is lower for us. So if Bitcoin's settlement price is above the strike in this instance, you lose money versus selling it in the market, but you get certainty and you get the fee. The option buyer, of course, will buy your BTC at the strike price at 27, and if it's 29, they'll sell at 29, so that is obviously their profit. Your actual P&L for all of this is the actual settlement price in the market at the time when it happens, right? So if we get the details, let's say the price of Bitcoin is 29 right here, obviously the settlement price is 29, right? And then you take your strike, which is 28. So you've lost $1,000 per Bitcoin there, but obviously you get the premium as well. Now you don't lose the money, but you just lose the money versus what you could have got in the market. So you can make the decision whether you're willing to lock in a price right here, take the premium and have the potential of, getting a worse deal in the future. But obviously with options, it's all about, having concrete prices and basically hedging your portfolio, which is what this is. The other thing we can do is invest US dollars, like US dollar tether. And what we're doing here, we're not writing calls. We're not giving people the option to buy our Bitcoin at a certain price. What we're doing is giving people the option to sell us Bitcoin at a certain price. Now, this obviously has options as well. You get a concrete buying price for your Bitcoin. If the price is actually lower, you'll pay a little bit more for your Bitcoin, but you get a concrete price and you get those premiums as well. So again, this has uses for certain investment cases. Once more, you can see the APY is much higher where the target or the strike price is much closer to the actual price. And when the price is much further away, you get a lower APY, just like on the other side. If you look at the details right here, you can see that you can invest US dollar tether, you get an ROI. The expiry date is today. right? So they make that as a 0.27% return in one day, which is obviously extremely good. That APR's out at around 16-40%, obviously crazy, but you're only earning a day's interest, right? And then you have to go obviously redo it. But the target price is 27 and the current price is 27,165. So what we're seeing here is that the target price and the current price is very, very close, hence the high APY. Now, what we're doing here is writing a put, and that means we are giving people the option to sell us Bitcoin at a certain price. Now, from their point of view, here's what they're doing. Here's the benefit they're getting. They are getting a strike price that is certain. They're getting a strike price that is 27,000, as you can see right here. This is the 27,000 here. What we're saying is you can sell me Bitcoin at 27,000, and the size obviously you can choose. From their point of view, they obviously make a profit if the price is lower than 27, and you can see that here. So they have to pay a premium to us, and you can see that happening here. So if the price for them goes down to 26, they still don't make much money because they have to pay that premium. But if the price goes down to 25, that's when they start making money because the price is much better even with them paying the premium. And obviously the most they can make is if the thing goes to zero, and obviously they make what they can sell it to us at, which was actually 27, right? Now from our point of view, what do? Well, we get this premium. If the price is above, they will not exercise, right? If the price is above, above, they will not exercise. They have the option to sell us Bitcoin at 27. If the price is at 28, they will not exercise because they can sell higher in the market. If they don't exercise, that means we just get the premium right here, and we can only make the premium. That's all we get, all right? We can't make more than the premium because if they don't exercise, and they just pay us a premium. But obviously we make a loss, as you can see here. If it goes to zero, we have to buy their Bitcoin at 27. So that's the risk, right? So from our point of view, what's it good for us? Well, we get the premium and we also have a fixed buying price for Bitcoin. If it gets to 27 or below, that's where we buy it at. The risk for us is if it falls to 25, we have to buy at 27. So we get a worse deal, but we're still getting the premium. If it's above here, then we don't buy any Bitcoin and we still get the premium. So it's like it's kind of a hedging thing where you say, yeah, I wouldn't mind buying some Bitcoin, but what I'm actually going to do is earn some interest. If it's above, then we'll go another day. If it's below, I'll get the Bitcoin anyway, which I kind of wanted, and I've got that premium as well. So just to go over writing a put and investing in US dollars, what we're doing here is selling to the market a put option, the right to sell us something. The buyer of those has the option to sell us BTC at the strike price, which in this instance, you can see 27. So they have the right to sell us Bitcoin at 27. At the money strikes, have a higher APY. Out of the money strikes, have a lower APY. You can see 26 is very close. We have a high APY. 24 is further away. You get a lower APY. If Bitcoin is below the strike, we lose money because we have to buy Bitcoin at 27 or 26 here. And obviously, it was below. So we could have actually just bought at a lower price. So we don't lose the money, but we just get a worse trade. The option buyer can obviously sell us their BTC at 26, 27, whatever it is. And then they can just buy it at the market cheaper. So that's obviously what they're trying to do as well. Our P&L, just like in the other instance, is the settlement price. Then we get the actual strike price and the premium that we get. We have to work out that. So in this instance, obviously, if the price is lower, we would have got a worse trade overall. And if the price is higher, we just obviously get the premium that they pay. So what I'm going to do now is compare writing the call, that's investing Bitcoin, and writing the put, that's investing US dollar or USDT. Who's it for? What are the pros and cons here? And why would you consider this? So as you can see, writing calls, that is investing BTC. Writing puts is investing USDT. Writing calls is mainly for bear markets because what you're doing here is really looking to sell your Bitcoin, right? So other people are buying that from you. Now, what you're doing really here is saying, I'm kind of willing to sell. And if that happens, then it's not the end of the world, but I want to get those premiums. If you think Bitcoin will not rise you can write a call to receive the premiums, right? So you can come over here and say, you know what? I'm kind of okay selling some Bitcoin. And what I'm going to do is I'm going to let you buy it off me at 27. And if it goes below 27, then I'll just keep it and I'll get your premium. If it goes above, then, well, I'll sell it. And, that's fine because I think that the price overall is kind of going at, a bit lower anyway. What we're doing really here is hedging our position. So if you've got Bitcoin, you're hedging your position, you're earning passive income from the fees, you're hedging it, and you're saying, if I sell it, okay, no problem. I'll sell it there at this price, but I want to get those fees. The risk is if the price rises, then obviously you do sell your Bitcoin and potentially you've got a worse trade overall. If you sold your Bitcoin at 27 and the price is 30, you've lost out, right? You could have just held it and sold higher, but writing calls and writing options is all about risk management. It's about saying, I've got some Bitcoin, I want to make some passive income on it. And if it goes out the door and I sell it, then that's fine, right? So it's all about earning those, kind of extra profits. In terms of writing puts, what you're really looking to do here is buy Bitcoin and you want to get a solid price for it. What you're saying is, I'm happy to buy Bitcoin. I want to buy Bitcoin, but I'm really not sure of the price. Instead of buying it in the open market, you write a put instead, and then this gives you some certainty. So you're going over to USDT and you're saying, I'm happy to buy Bitcoin at 26, but I'm not just going to buy it at 26. What I'm going to do is come over here and get some premiums from you guys in the meantime. If the price goes up, I won't buy any, but I'll get your premiums. If the price goes down, then, I'm looking to buy Bitcoin anyway. I may have got a slightly worse trade, but it's all right. I've got those premiums, right? So it's all about having certainty of your buying prices and getting the premiums on top. You can see you benefit from the premium. If the price falls a lot, you'll buy BTC and receive the premium. You might get a slightly worse trade, as you can see here, than if you'd have just waited. But what you do get is certainty. That's what options are about. Certainty of price, receiving premiums. And if you want to do either one or the other, that's buying Bitcoin or selling Bitcoin, you can get certainty of price and receive premiums in the meantime. I'll show you exactly how to get into a contract and then show you the pros and cons, right? So you can just literally go onto the system. You can do this on your phone as well. Like I said, the link is below. So if you want to sign up, they sometimes have sign up bonuses. You can check out that as well. I'll leave the link in the description, but you can literally go to details. If you want to enter into this product, you just click buy. Obviously, you need US dollar tether into your account. If you want a step-by-step guide for Pionex on how to get set up on the system, I'll leave that linked in the description as well, how to get USDT on there and everything. But once you've got the amount that you want to get into, just press buy, and then you get into that option. Now, you cannot get out of this option. You have to wait until the expiry because an option is a contract between you and someone else. You can't get out of it. It's not like a lending product or anything like that. So be sure that you're happy with this, put the amount that you want to trade in there, and then you have to let the duration run out. And this is only today, so this is going to run out today. Just click buy like that. Now, what are the pros and cons? The pros are you can earn extra yield on your portfolio already. You can get extra income when you are looking to buy, and you have a specific price that you're going to buy and sell at, and you get the extra income. You can hedge your position as well. If you've got Bitcoin and you're looking to potentially sell, you can get premiums. So you get certainty of price and extra income from the premiums. The downside is that you are taking risk of swapping out from one crypto to the other. So if you're not specifically looking to either buy or sell Bitcoin and you're happy to actually have those trades, then obviously this is not risk-free because you can potentially get into something where you invest BTC, suddenly you're sold out of BTC and you didn't want to do that. So hopefully this video explains what those actually are. There is of course risk that you're trading out at a worse price than if you would have just held the assets anyway, right? So if you do trade out, for example, the BTC option right here, if you do trade out, it means that the market price is better for the buyer than for you. And so you're basically taking that risk of getting a slightly worse trade. The opposite side is you're getting the fees. So you are taking risk where the crypto, potentially moves higher and you're kind of, having to, sell it at a lower price. But hopefully that explains the difference with the options and who they are for. Come into the public Discord server if you want to ask more questions. I'll pin that as a comment. I'm in there. You can ask me questions. If you want to sign up for Pionex as well, see potential deposit bonuses and everything, I'll link that in the description and pin it as a comment as well. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.